Good morning, everyone. Welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The debt ceiling negotiations, which was concluded by Biden and McCarthy, now face the congressional hurdle. Intense lobbying is going on by both sides to pass this resolution smoothly. On the other hand, interesting developments from China as Chinese stocks listed in Hong Kong are getting battered due to high investor expectations and the disappointing reality. They have been leading the headline in geopolitics as well, more recently cutting off undersea internet cables of Matsu Island, which is part of Taiwan. Good morning, JK. Interesting developments going on. Take us through what's been grabbing your attention since the last 24 hours.
Hey, good morning. First, on the point of Hang Seng Index, which has retreated 18.2% from the January peak, mainly due to China reopening trade, which has started to lose momentum and erasing nearly 600 billion of US dollar from the city's stock valuations. And the recent ban on chip exports to China by US has only added to the bearish momentum, besides uncertainty about the debt deal. That said, the technicals show the market somewhat oversold and due for a recovery, with the weekend deal in US debt providing some fillip. On the debt, coming back to the debt ceiling itself, the process of approval for deal by the Republican and Democrat parties is on. Republican side, there is some opposition from environmentalists, defense hawks, and conservative hardliners condemning the concessions. However, the voting on the US ceiling is expected to begin Wednesday, and there appears to be sufficient support for a clear passage. Now, the focus is shifting to the other side, with the Treasury General account needing to be rebuilt, meaning a deluge of bill issuances, with some estimates as high as 600 billion US dollar within 6 to 8 weeks of the deal. As liquidity gets drained from the banking system with the bill issuances, what impact it could have on the broader markets is the question that analysts are trying to answer. Some estimates suggest that it could be equivalent of 25 basis point rate hike as far as the financial conditions are concerned. Meanwhile, the Fed Watch tool predicts that Fed will deliver a final 25 basis point rate hike in June and reduce the rate by 25 basis points by the end of 2023, followed by another 175 basis points of cut by the end of 2020. So quite a bit of revision to what estimates we were hearing earlier. As far as stocks are concerned, US and UK markets were closed yesterday, and we saw a positive momentum of Friday carry into Asian markets. However, the European markets were on the losing side. In fact, they have been losing in the last few sessions on debt deal uncertainty. And apart from that, the slowing global demand and expectations of further rate hikes by ECB, which will affect the corporate profits. And also, besides hitting all-time new highs, there has been a profit taking by the investors as well. The latest negative factor was a sudden announcement of elections by the Spanish government yesterday. On the dollar, DXY has seen some profit taking yesterday on recent longs after news of a deal reached on the debt, but no significant loss in the dollar has been seen. Probabilities of a rate hike in June has increased as per the future markets, but in the current price of the dollar, that has also been probably discounted. Hence, we are not seeing much movement, but there will be more cues for the US economy as we head into the employment data and the preliminary indications of the job market on Thursday, apart from the manufacturing ISM on the same day. I expect dollar index to range for the next few days as we await formal passing of the debt deal in the US Congress, as well as developments on the liquidity front, as the Treasury seeks to refund itself through issuance of T-bills. Meanwhile, yen has been the only currency to show decent moves, and it has weakened to new cycle low of 140.92 in Monday's trading after the debt deal was reached, but has since fallen back. I mean, the dollar has fallen back to around 140 amid murmurs of Japanese officials' discomfort with one-way weakness in the yen, apart from a retreat in the long-term US bond yields. Meanwhile, there has also been a further positive news from the Japanese economy, with jobless rate coming down to 2.6%, better than the previous number of 2.7 and better than expectation of 2.8%. Now, in yields, we saw very little movement due to holiday in UK and USA, but there was a small fall in long-term bond yields. On the rupee, it touched first support of 80 to 50 yesterday, where we saw good buying emerge, and it fell by 15 paise during the day. But more significant was the fall in 1 year forward premium, which fell as much as 12 paise. And at 1 rupee 45 paisa, or at 1.76%, it's close to the December 2022 low. This is the direct impact of a rise in US yields, and it makes the USD-INR shorts less attractive, which is why perhaps we did see the spot rupee weaken on the day. Of course, the offshore yuan falling to new low of 7.0912 also pressured the rupee lower. We have a situation where domestic macros keep improving, but global cues are negative for the rupee. Due to this conflict, I expect the rupee to remain in a stable range compared to other peers. However, at least the stock market in India is definitely ignoring the global negatives or uncertainties. We had the bank nifty hitting a new all-time high yesterday, and even as the Indian equity market cap in the global has hit fifth position once again. So on that positive note, we end today's update. Thank you.
Thank you, JK. And just to quickly summarize, Chinese reopening was a little bit disappointing and along with the ban of Chinese chip manufacturers in US, Chinese stocks are getting battered. But as of now, it seems it's on the oversold side. Debt ceiling voting will begin on Wednesday. After it passes within 6 to 8 weeks, new issuances will be done, which will further tighten financial conditions. Some say equivalent to a 25 basis hike. Dollar has seen some profit taking, but without any significant loss. While the probabilities of a rate hike in June have increased, and there are a lot of data with respect to the dollar this week, jobs data along with manufacturing index, which is all due on Thursday. While Japanese economy continues to shine, the jobless claims have reduced to 2.6%. On the domestic front, rupee, we are seeing 1 year forward premiums falling by 12 paisa yesterday, which is due to rise in US yields, which are making shorts less attractive. That's it from us today. Tune in tomorrow for another round of fresh updates. Thank you so much for listening.